Hi, welcome to this episode of Talking Tax with Alex. This is part 2 of our Investing in Real Estate Partnerships series. In this episode, I'm going to quickly talk about what we're covering, what each video will cover. So this is part 2, which is basis limitations and passive activity losses. And then I'll wrap it up with some closing thoughts. So this video is for those taxpayers who are looking to invest in real estate and want to know whether they can take the losses or what it'll take for them to deduct their losses on their tax returns. Real quick, we're going to revisit our example with Aaron and Brittany, who create a real estate investment company and contribute cash like so. So they contribute $550,000, they take a mortgage out, buy a building for the remainder. For this example, I kept it simple. So a lot of facts and circumstances, there's no land. I know that's not realistic, but there's no land in this example, just to make the numbers work out nice and easy so that we have depreciation of $100,000. And that brings us to our issue. Can Aaron or Brittany deduct their share of $100,000? So we're going to talk about the basis limitation here. And so basis is a really big concept. I'm going to try to boil it down here. What is basis? Basis is formulaically this: your initial investment plus or minus your income or losses, plus your share of the liabilities, minus distributions, aka any money you take out of the company. If you run out of basis in your partnership investment, in your real estate investment in the partnership, you don't lose the losses, they get suspended. So you can take them at a later point in which you have additional basis. There's also a tax trap in here for basis. So that last step, when you take money out of the partnership, those distributions, if you don't have any basis and you take distributions out of the partnership, the real estate partnership, those are going to be taxable as capital gains to you. So that's why it's important to know what your basis is in your investment. Typically, your CPA or your tax preparer is going to do this, but if you're watching this video, at least you want to know that you can ask your tax preparer how much basis you have. It's going to let you know how much money you can pull out of the partnership. So what are some planning tips around basis? Well, you can contribute property to increase your basis in the partnership. The partnership itself can increase liability, so it can take on more debt and therefore give you a larger share of your partnership liabilities. That'll increase your basis. You can change how the partnership allocates the liabilities. So in our example with Aaron and Brittany, Aaron is 10% owner. Maybe he wants to take on 25% of the liabilities. That'll increase his share of liabilities, or that'll increase his share of the partnership liabilities and therefore increase his basis. You can also specially allocate income. So if a partner has a bunch of suspended losses, you can write in the partnership agreement that if a partner does have a bunch of suspended losses, then they will receive the future income to allow them to use their suspended losses. A partner can also personally guarantee debt and turn non-recourse debt into recourse debt. I'm not really going to go into recourse, non-recourse, qualified recourse debt in this video, but this is another tax planning tip that's available for you if you need to. Now we're going to talk about passive activity losses. So what are passive activity losses? How do PALs work? It's an acronym. How do PALs work? And what are some planning tips to deal with this? Well, passive activity losses are, in a nutshell, a classification of income. So you either have active or passive income and losses, and passive losses can only offset passive income. Rental activity is passive by default. And so just like basis, this topic is really, really deep. So I'm not going to go too deep into it. But what dictates what income is passive or non-passive? Well, there's a bunch of tests. It's called material participation. And the most common one is whether you spent 500 hours in the year doing the activity. For real estate, there's also the real estate professional, which is 750 hours. Again, I'm not going to go too deep into it, but those are ways where you can change the classification of your rental activity from passive to active. Why is that important? Well, if you have active income like your W-2, or if you own a business and you run a business and that business is making income, you can't use your rental losses to offset your W-2 wages or your business income. That's why this is important. So just like basis suspended losses, your passive losses, if you can't use them, they're not gone. They just get suspended and they carry over until you have passive income to offset it against. So what are some planning tips that you can use to get around or to optimize your passive activity loss situation? Well, you can create passive income. If you know you have an investment that you can make and you do not spend a lot of time in that activity, and it makes a certain amount of money, then you can use that income, or you can offset that income against any losses you have from any rental properties. You can materially participate in the partnership. That's an option for you if you really want to, and if it's your part-time job. Again, 500 hours is not. I mean, it's a lot, but it's not like a full-time job of 2080. That's your typical full-time job. So you can spend 500 hours materially participating. You can qualify as a real estate professional. Again, the thresholds here are a little different. I'm not going to go into that here, but this is another way where if let's say you operate many rental activities, you have several rental activity partnerships, and you own a building and you invest in other ones, and this is your job, is investing in real estate. Potentially you can qualify as a real estate professional as defined by the IRS. Another one is you can just dispose of the rental activity. Again, maybe you don't want to, but this is a way where all your unused passive losses will be able to be used in the year that you dispose the activity. So if you've pooled up 5 or 10 years of passive losses and you just dispose of the rental property, you're not losing your losses. They've accumulated and pooled, and in the year that you get rid of the rental activity, let's say you made some money on it, all the losses you've accumulated along the way are going to offset that gain, which is kind of cool. Potentially offset that gain. So again, just like with the first video, real estate investments, real estate investment partnerships can be very complicated. We covered 4 very common limitations to losses, and you need to consult your CPA to really understand what your tax situation are. The main takeaway is your real estate deductions are not guaranteed. So that's it for this video. If you like this content, please like the video, subscribe to my channel, and comment or email me your thoughts. Thank you. Bye-bye.